The Federal Reserve is walking an absolute tightrope. Markets are going crazy. We've seen one of the most volatile months that we've seen since the COVID-19 variant came out. Stick around for the economic update here, along with myself, Dean Barber, founder and CEO of Barber Financial Group, along with Bud Casper, president of our Lee's Summit location, Matt Casper, certified financial planner in Lee's Summit, and Jason Newcomer, director of financial planning and certified financial planner. We've got a great conversation here about what's going on with the volatility and what you need to know moving forward. Hello, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group. Welcome to the monthly economic update. We got a great program for you today. We've got Bud Casper, certified financial planner. We've got Matt Casper, certified financial planner. Jason Newcomer, certified financial planner, all with Barber Financial Group. We're going to talk to you about what's going on here in the month of January as we record this. It is January the 26th, and man, has it been a wild ride. We've seen the Dow Jones Industrial Average go from a negative almost 1,100 points in a single day to back to a positive over 100 points. We have the NASDAQ that very same day was down over 4.5% and winds up positive on the day by 0.63%. And if you've never been bungee jumping for real, I promise you that that's exactly how everybody that has money in the markets feels right now, is if we've been bungee jumping for the last month. I want to go through a few key stats here, and then we're going to get into a little roundtable discussion with our certified financial planners. So I want to look first, guys, at the S&P 500. And when we look at the S&P 500, right now we have 96 of those 500 stocks in bearish territory and look to remain in bearish territory for the near future. Only 55 of the stocks out of the S&P 500, just a little over 10%, are still showing a bullish rating. The balance of those are neutral. And so that puts the overall S&P 500 in a neutral position. When we look at the NASDAQ, we have a similar story. We have 23 of the NASDAQ 100 stocks in showing a bearish rating and only 6 showing a bullish rating, and the balance in neutral, putting the NASDAQ into neutral position. So we don't have the entire indexes showing a bearish overall showing right now, but we definitely are seeing some signs of increased market volatility. I mentioned at the beginning of the year in our economic update for December that we anticipated more volatility this year. Man, are we seeing it. So let's first turn to Jason Newcomer. And Jason, what do you make of the market volatility right now, and what kind of conversations are you having with your clients right now?
Yeah, I think the one thing that strikes me and probably all of us is just it seems that the speed of which things are happening has accelerated. It seems like this has just been the last few years where things just happen so quickly. Whereas, a 10% pullback in the market used to take maybe a month or two to play out. Now we see that play out in a matter of days. But I think even though things have accelerated, things are happening much quicker. It's still important to provide context, and we always look to the past to kind of help us provide some of that context. I think as we're on this call today, I guess don't blink because things are moving that quickly. At some point during the day, during this week, the S&P was down more than 10% from its previous all-time high. So to provide some context, is that normal? I would argue yes. Over the last 90 or so years, most years have had a 10% pullback somewhere in that calendar year. So what we've seen is normal, albeit the speed is completely different. Maybe you could make that argument. But it's just important to have that context from a historical perspective so that emotions don't run crazy and take over and we lose sight of what's really important.
Right. Of course, Jason, the important thing is that people don't have the money that they want to spend over the next year or two in stocks right now. Anyway, they should always have a fair amount of money in very safe positions so that they don't have to worry about these short-term swings in the market. Matt Casper, certified financial planner, Lee's Summit location for Barber Financial Group. Thanks for being here. Matt, you mentioned something this week during our brainstorming session as we were talking about this market volatility, about panicking, about fear, and you likened it to the beginning of the COVID-19 pandemic that began late February of 2020. Talk to everybody watching here about what you were saying.
Yeah, when you think about really just going back to 2018, I mean, and just trying to identify a lot of these significant pullbacks, we're in the third most significant pullback since that date. One was fourth quarter of 2018, then of course the COVID crisis, and now we're in this most urgent event that's been taking place recently. And the question, what should we be doing? And it's real easy for us to run into that fear factor, seeing these excessive drops at the quick pace that Jason was just identifying. And the real question is we need to get back to the basics. And some of the basics are doing the things like I know we've talked about in the past, is doing those appropriate rebalancing where we're making sure that we're covering, future distributions, future withdrawals, and so forth. And at the same time, sustaining the appropriate risk level that's going to keep us healthy in the long term inside of retirement. So I think that's very critical for us to make sure that we don't lose sight of what we're trying to accomplish in the long term, even though I know these jolts in the market feel very uncomfortable. And of course, like Jason was saying also, we need to get used to having these corrections in place. About every other year, we're going to go through these type of experiences. About every 6 to 7 years, we're going to go through a true bear market. And I think that's what we all get concerned about, is when the next bear market is going to be.
Matt, thank you. Bud Casper, I like to refer to Bud as the original certified financial planner. Bud, I want, from an economic perspective, your take on what's causing all this volatility right now.
I'll answer it one way. It's the Fed, stupid. It really does come down to what the Federal Reserve is doing. And of course, the issues at hand is, are they going to be able to raise the rates without having an upset to the economy and the market reacting negatively on top of that? And so with that being said, I like your bungee jumping concept that you have here, because it most certainly has felt that way recently. But recently I had the opportunity to talk to a manager of one of the largest mutual funds that is out there, just to get his concept as to what's going on. And I have to say that the words that he said were ships and chips. And what he meant by that, obviously, is we have this clogged economy because we're not getting goods and services out to the city so we can have food and sundry other items that people will live with on a daily basis available to us. And the chips have become so scarce at this time, it's actually crippling some of these companies' abilities to be able to produce their products. And of course, that's going to be a negative impact until we finally get that cleared up. So the administration better get its act together, because right now it's not providing these companies the opportunity to be able to make money when the fundamentals associated with being able to get goods and services to the people at large are in place.
Jason, I want to go back to you here really quickly. You made a pretty bold move in 2020 at the end of March into the quarter there when the markets had a pullback, and you said, hey, you know what? It's time to rebalance here. Let's sell out of some of these fixed income assets that did really good in the month of March, and let's buy some of these equities that are down by 35%. And of course, people were saying, oh my gosh, you're crazy, because look, the markets are down. We don't know what's going to happen with COVID. And that was using just fundamentals, Jason. So talk a little bit about that, because I think it's important that people understand when we're in these times that we don't think on an emotional level. We really want to try to think from a logical level, do our research on how things have played out in the past, and use that as our guide for how we treat things moving forward.
Right. Yeah. So flashback to March in 2020. It was the middle of the month and the market had fallen by 20%. And that's when we did our initial rebalance and thought, I was sitting there thinking, gosh, what a great opportunity to rebalance here. The markets are down 20%, and at some point they're going to recover. And we're going to look like all stars because we did this rebalance. And then the next 5 days, the markets fell another probably 11 or 12%. And I was like, oh my gosh, that happened a lot quicker than we thought it would. But we did another rebalance. We actually did 2 rebalances in the month of March. And in my wildest dreams, I would not have anticipated how quickly the recovery came. I think even in my most optimistic, I was thinking this is going to take a year or so to recover. But within a year, things had bounced back. So while the rate at which things are changing is unprecedented, I think the fundamentals of investing and rebalancing and having a good, solid, diversified portfolio strategy remain unchanged.
I totally agree with you, Jason. And I think if you think about where we're at from an economic perspective, we're actually seeing good, solid fundamentals from an economic perspective. We've got low unemployment, and we could say, well, that's due to low participation rate in the workforce. But the reality is, we've got a workforce out there today. If you want to find a job, there's plenty of jobs to be had, because there's actually more jobs to be had than there are people looking to get hired at this point in time. That's causing some wage inflation pressures. But you've got corporate earnings that are still remaining extremely strong. We're looking for a slowing growth economy this year. So as opposed to growth that's just taking off, we think that growth's going to continue to be there, but growth is going to slow as we go through 2022 and through 2023. And if we remove the Fed, Bud, your analogy there for a minute, if we can just remove the Fed from that equation, and we know that the economy is slowing, we can look forward and forecast that the economy is going to grow at a slower pace in 2022 than it did in 2021. We can look forward and see that the economy is going to grow at an even slower pace in 2023. And so this volatility that's happening right now could well be a reaction from the market saying, you know what, Powell, you got it wrong. Inflation was not transitory. Powell, you got it wrong. Strike two. You didn't start raising rates fast enough to get ahead of this crazy inflationary period. So the market's wondering, Powell, are you going to get strike three and now be too aggressive and send the economy into a recession? Let's hope that that tightrope that Jerome Powell is walking, he can do it right and send us into a smooth, soft landing, slowing inflation, but yet allowing the economy to continue to grow at a healthy pace. Matt Casper, last thoughts on what you see in the economy and your thoughts on what I just said.
I couldn't agree more. The real question is, if the Fed does start to increase these rates, can our corporations sustain these higher wages? Can they sustain the higher supply costs and ultimately continue to experience some growth inside of what they're projecting for their own returns? Because this rising rate environment can ultimately create some headwinds for them. And if we start to see economic growth continue to wane, then essentially that can become a headwind to the total market itself. So just want to be cautious. I'm with you as far as what Jerome Powell has up against them. And of course, we're going to look for that proper guidance, hopefully that the Fed will be able to accomplish. The only thing that I can say is if the Fed starts to increase and we start to see the slowing in the economic growth, at least we would anticipate them to start to reduce those rates at the same time in anticipation of what's going on.
Bud Casper, final thoughts on the short-term economic outlook and through the end of 2022.
Well, my personal thoughts on that is the Fed's behind the eight ball. What I mean by that is I made a statement back in June and July that they better start raising rates by the end of the year, effectively in December. That did not happen. I hate it when the Federal Reserve has to start playing catch up, because that suggests that they might raise at a faster pace or do more than just a quarter of a point. They won't do that because they don't want to look like extremists. So my best case at this particular time is we'll see 3, possibly 4 increases, but the Federal Reserve is not going to get in a hurry. They're going to measure their way into this, and look how the economy is reacting at that particular point, any point in time this year. So with that in mind, and they've seen this before, so they do have the experience to be able to guide us where we need to go, and of course the markets are going to act appropriately.
Bud, thank you. Ladies and gentlemen, thank you for joining us for the monthly economic update. I'm Dean Barber, along with Matt Casper, Bud Casper, and Jason Newcomer. If you have any questions for your financial advisors, make sure and reach out and schedule a quick conversation, whether it's a phone call, a virtual meeting, or an in-person meeting. We'll talk to y'all later. Everybody stay healthy, stay safe. We'll be back with you at the end of February. If you're watching us on social media, make sure to give us a like, a thumbs up, start some dialogue with us, share this with your friends. And if you're watching us on YouTube, make sure to subscribe to our YouTube channel, give us a thumbs up, and share this video with your friends. Thank you so much for watching.